think the bond market's doing what the bond market always does, which is I always think regulates growth. So in my opinion, the bond market, think about we're investing in 10, 20, 30-year bond yields here. So we're thinking about market, what are interest rates going to be doing over that time? What's the economy going to be doing over that time, and so on. And I think what the bond market is doing somewhat is looking through, in a sense, the stimulus. So, the stimulus comes and goes, and within 2 or 3 years, it'll largely will have dissipated somewhat, and we'll be left with how the economy really tends to work back in the old days. And what the bond market always does, I think, when the Fed's not in the way and trying to push it hard one way or t'other, is it regulates the growth of the economy, and it does it via the key cyclical areas of the economy. So things like housing, autos, and so on. And you can see that in the housing data. So bond yields back up hard at the end of last year into early this year. And you start having an impact on housing. The cost of mortgages becomes more expensive. You get a response from housing. Housing slows a bit. We see the housing data come off. And to my mind, then bond yields follow. And you get into this sort of, this step up, this track sideways, and then later in this year, or maybe into next year, I think bond yields will start backing up once again. But I mean, that's certainly the economic side of it. There's also some technical sides and some liquidity sides, which we can talk about as well. But to my mind, the bond market is doing what it always does on the tin. It regulates the growth, and it gives you that sort of mini cycle and in the wonderful way that it does. Well, the bond market's sort of the beginning of financial markets. The US 10-year bond yield is the risk-free rate. It's the basic building block for any valuation model. So equities are valued relative to bonds. Within the equity market, I like to think of the global equity market as, I like to think of it as 3 sectors. You can think of it as 10 sectors or 25 industry groups, or you go even further down than that. But I like to think of the top 3 sectors really, which is cyclicals, growth stocks, and defensive stocks. And, you think of consumer staples and bond proxies, utilities, they're all about the bond yield. Really, that dictates an enormous amount of their movement. Growth stocks, of course, tend to like lower bond yields, and they don't like high bond yields. Although, again, there's, that's not always the case, but that's often the case. And of course, cyclicals, financials is the obvious example. They tend to correlate very highly with bond yields. You think about a bank borrows short and lends long. So the steeper the curve, the more the bank valuation tends to go up, and the more its earnings growth comes through. So the bond market is telling about growth. It's telling about earnings growth. It's telling about those 3 big sectors in the economy. I mean, it has an enormous bearing on financial markets and how they play out. I'm kind of with the Fed. I think it's transitory in the short term. We've had these 2 big core CPI prints of 0.9 and 0.7, and you can see that the 0.9, 30 basis points of that 90 basis points is just car prices, and then another 15 is other one-off factors. So you can see how there's a lot of one-offs in there. It's to do with reopening. We had a bit of this when they reopened last year in Q2. So July 2020 had a big spike up in core CPI. So core CPI, I think, is very much transitory. The other thing I'd say in the short term is that the supply side of the US economy and the global economy is in very good shape, surprisingly. Bankruptcies absolutely collapsed last year, which was extraordinary. If you think you go back 12, 14 months, we're all talking about the massive insolvency risk and the huge bankruptcies that would come from one of the deepest recessions on record in many, many, many decades. So it's very impressive what policymakers have done in terms of bridging that economic chasm. But bankruptcies are low, so the supply side is good to supply into that demand near term. Now, in the short term, I don't think there's a big inflation problem. In the medium term, I would say I think there's a changing inflation landscape, and I think it'll be much more challenging once you get 2-3 years out. If you're a long-term investor, there's going to be a very different next few years from the last few years. The last 10 years, really post-financial crisis, very much about growth stocks. I think those days are largely behind us, and many investors already started shifting, as they should have, into more cyclical and value stocks and reflation trades and so on. And I think that trend is it's having a bit of a pause at the moment, and that pause may last for quite a few months. It's like the bond yield, there are chapters. It's not just a straight line. So the main trend in the bond yield is up over the next few years, I think. But actually it's pausing at the moment. And I think the sector allocation, the main trend in the next few years is buy value and cyclicals and commodity plays. Be great for Australian equities, I think, great for the Aussie dollar. All of that's very positive now. It's a very different world from the last 10 years coming into this. But there's a pause in that now. I think that's the point. It's just not a straight line. So we had a very aggressive move into cyclicals, as you'll know, and value and financials until recently. And I think there's a bit of a pause that over coming months while we reset and digest a bit of, the changing monetary policy landscape. In the background is really that we've had an international monetary system that has been in place since 1971. And it's a dollar fiat system where the dollar sits at the center of the global international financial system. 60 to 70% of global investments are dollar denominated. 60% of trade is dollar done in dollars, and so on. And the dollar is the reserve currency. So we've had this financial international monetary system that's now over 50 years, or it's 50 odd years old. And on average, those systems last really 25, 30, 35 years. So this is a very long lasting system. And most of these systems, there's no perfect system. And over time, they build up tensions and they really expire, I think, in terms of their ability to cope with it being the underlying base of the global economy. And that's what's happened today. And part of that is because of that debt super cycle that you mentioned. And the drivers of that debt super cycle are really related to the structure of the system that we have in place today. And there's lots of drivers of it, but I think one very important one is the fact that in a dollar fiat world, you don't have an anchor in the international monetary system. And if you look back over history, pretty much every system over, indeed, several hundred, even a couple of thousand years has had an anchor. There's always been some sort of anchor. And what the anchor does that's really important is it limits the ability of the financial system to create liquidity. And of course, if you can create liquidity, it's like Mervyn King, our former Bank of England governor, said, whenever a commercial bank makes a loan, it creates new money. So 97% of the money supply that's in existence today was created by commercial banks. And in fact, that was done when they mostly made mortgage loans. That's primarily what they've been doing over the last 20 or 30 years. I mean, Australia is a case in point. Just like the UK, you have a very concentrated banking system with 4 banks that basically do a ton of mortgage debt. And that is their primary driver of their profits and the primary thing on their balance sheets. So the fact that we haven't had an anchor in the international monetary system has allowed this massive creation of mortgage debt over the last few decades. And I would argue that the reason house prices are so high is not because of a lack of supply of houses. That's certainly the argument that goes around in the UK. And look, there's a bit of that. If you're in, I'm trying to think what the most exclusive area would be. Bronte Beach comes to mind. I'm sure it's not the most exclusive, but it's probably up there. There, in London, we'd say Mayfair. There's only so many houses in Mayfair, and there's people really want to live there. So there's a lack of supply there, but there's not a lack of supply of housing in general. The reason house prices are so high in general across the globe is because of massive creation of money and massive supply of mortgage debt. And that's what's pushed house prices up. And the only way you can achieve such massive creation of mortgage supply is by having an unanchored international monetary system where you can create as much liquidity as you want. So that's my point. We have a debt super cycle. It's 3 decades old. Global debt's just taken another leg higher in the pandemic. It's a tired system. It's really beyond its sell-by date, and it needs to be changed. The only challenge here is kind of the big one, is finding political will and politicians that are going to make it happen. And at the moment, there's an absence of them. But at time, hopefully, they'll come up and step up to the plate. I don't know, but maybe we need another crisis. No one ever needs a crisis, but maybe it'll take another crisis to get politicians to finally address this issue. And a new Bretton Woods conference, as they did post World War II, get together, sit around a table and discuss how a new system could work. I think for an average investor with a long-term time frame, you need to think about the long cycles. And, I always think that every sort of new economic cycle has a big themes to it. So, and you can see that in the global stock market, and you can see it going back over many decades. So, for example, in the last 10 years, it's been driven by growth stocks. You shouldn't have been in commodities. You shouldn't really have been in emerging markets on the whole. And the US dollar has been a strong currency post GFC and so on. The prior 10 years to that and the run up to the GFC was a very different landscape. You should have been in emerging markets. You should have been in commodities, in banks, in energy stocks, in Aussie dollar, in Aussie equities, and so on. So you've got to pick up the big theme of the next few years. And I think the big theme is very much that bond yields are trending higher. So that's not a great place to put your money. With that, I think you'll find that financials do well. We've got a comeback for the banks globally. It's most obvious in the US and Western Europe, particularly the UK. But even in Australia, I wouldn't be surprised. I know you've got a sort of slightly different cycle going on, but commodity prices should do well. So that great for Aussie equities and all that sort of stuff. Great for the Aussie dollar. And good for emerging markets. I think there are lots of ways of playing this. One way I really like is I think this is going to be a good few years for global trade. And there's a lovely basket of Southeast Asian equity markets, which is sort of Malaysia, Thailand, Indonesia, and places like that, which do remarkably well, their stock markets, when global trade does well. And I think this will be a theme of the next few years. So there are lots of things to do, but primarily I would say underweight sovereign bonds for the next few years, and it'll nip and tuck, and overweight the sort of value reflation cyclical areas of the market. So if I was a private investor, long-term investor, I'd take the opportunity of the next few months to sort of, I think there'll be a bit of counter trend movements over the next few months in those themes. Take that opportunity to put money to work, basically.